Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Felipe Schuurman, CEO and founder of Sparta Commodities, based in Geneva. Felipe, great to have you join us today.
Thank you, Diana. Very nice to see you, and thanks for inviting me.
Great to have you. Well, I mean, obviously, lots to talk about. We all know the events of the last 48 hours and what's happened here in the Persian Gulf, where I sit, or the Arabian Gulf, both, to be fair. Let's start by talking about, it's Monday morning today as we're recording, and we've seen oil markets open. Prices did spike, but spike is a big word, isn't it? Because in the past we would have, the markets may have reacted much more as an instinctive blip to these events that we saw in Iran and around the region. Do you think that the reaction has been within expectations for what we've been seeing develop over the weekend in terms of oil prices?
Yeah, sure. It is indeed surprising. I think that most polls over the weekend were expecting a rise of, flat price at anywhere between 80 and 90. We're struggling. I think it started off the morning at 81, but then it came down. So it is surprising relative to what was expected. But we need to look at the facts of what has happened over the weekend. And for the time being, there is a sort of de facto closure of the Strait of Hormuz, mostly because of insurance companies putting in barriers or increasing their insurance coverage, owners not even willing to quote, or trading companies not willing to take the vessels through the strait. So all of this basically means that there is let's say, a logistical disruption, but we have not yet seen any kind of supply disruption. So I guess that is what traders are considering right now, and that's why we have not seen a flat price that, again, based on the polls that we've seen this weekend, were expected to be much higher.
Yeah, and I mean, as you say, we saw prices blip to X, and now they're sort of, I suppose, steady for the time being. I mean, there was a lot of talk in the last month, of course, that the geopolitical premium being put into that. We've seen a move up of nearly to $8 to $9 since the beginning of the year in the oil price, and that has been attributed not to fundamentals, but to this risk expectation. So, I mean, is that the reason why we didn't see a $10 or $15 increase this morning? I mean, how much risk premium do you think had already been factored into these prices?
Well, I mean, let's not forget that we were heading into this weekend with very different views in the market. The fundamental story over the past months has been this supply glut that has failed to materialize because of multiple events. The cold snap in the US, and obviously the geopolitical tensions, whether it's in Russia, Ukraine, with bombings of Russian refineries and things like that. So that has had an impact. And obviously, people are pricing in or were pricing in this potential conflict in Iran. So yeah, the fundamentals were and have been for a while quite bearish, but the reality is that the bearishness is not on the pricing centers, because most of the oil in sea is what was considered shadow oil or non-legitimate oil. But now, obviously, that is completely part of from the discussion, and right now everything is about Iran, for sure.
Absolutely. I mean, you mentioned, of course, the flow. Let's talk about the physical flows, the ships in and around the Strait of Hormuz, clearly clearing the area, as you said, over the weekend where they could, again, because of insurance coverage and pure safety and security. Absolutely. I mean, forget about the cost. Let's just think about if they're going to still be there. We did have one ship receiving some fire near the Gulf of Oman, but again, sketchy details there as to what that is. Are these direct targets? Is it shrapnel, etc.? But in terms of the insurance and freight rates, let's just look at that outside of
Yeah.
how it might influence, traders and the trading community, and how disruptive and in terms of stymieing those flows. I mean, at the end of the day, you've got Asia to the east of here waiting for these barrels, and we'll talk about storage later. But how, this insurance freight rate scenario from a cost point of view, how disruptive do you think that's going to be?
No, that is the most important factor right now. Okay. And things are evolving constantly. So
Mm,
whatever I say now might change in 10 minutes. No,
absolutely.
but for sure, the biggest impact right now and what people should be paying attention to is freight. Freight, as I said before, there's a de facto kind of closure of the Strait of Hormuz because people don't want to cross it. I think there's something like 200 vessels that have dropped anchor and waiting for instructions, if you want. So what does that mean? It means that there is a tremendous impact on the logistics, whether it's crude, because even if you had supply, contracts of crude from suppliers that were able to supply because the ports are not shut down or anything like that. But
Yeah,
if no one is willing to take that oil, then the biggest impact is obviously going to be on freight rates because there's less. Or it was already freight rates were already at eye-watering levels before we started this weekend. Now, God knows what will happen. It's going to be very uncertain what kind of prices if people are willing to quote a price. That's the first thing. So overall, even outside of the AG, the ton mile, the dollar per ton, if you want, on a freight rate
mm,
is going to be increasing dramatically. Now, that has an impact on particularly Asian refiners, not just on crude, but also on naphtha and LPG. Because if the crude is delayed, because even if the war is only lasting for, let's say, a week or something like that, God knows, but it will have a dramatic impact on flows. And
yeah,
that could affect refining capacity in Asia, where they would be reducing or trimming runs in order to
yeah.
compensate. That means that they'll be producing less LPG, naphtha for the different units. And if the LPG and naphtha doesn't come from the AG neither, then you're going to have even more disruption on the refinery system. So that is the biggest impact that I'm seeing right now.
Okay, I mean, absolutely. And the other sort of thing to consider in terms of from the point of view of large consumers like China, like India, like Europe. And we'll talk about gas and LNG later if that's okay with you. But just sticking to oil for now, the talk in recent markets has been, oh, plenty of supply, plenty of storage. China's been, storing up lots of inventory as prices were low in the last few months. No one knows the exact figures there. The US SPR also is healthy apparently, and OECD has 1.2 billion barrels of emergency reserves at its fingertips today. So, what's the panic about, if you like, in terms of prices inching higher? I mean, should those major demand centers feel relatively secure for the time being because of
Yes, I
storage
mean,
levels? Mm,
yes, exactly. As I said, the fundamental picture was bearish to a certain extent before this event, and
mm,
the flat price was mostly connected to geopolitical tensions. That being said, um, let's not forget that we're talking about 20 to 25 million barrels a day that is moving out of the Strait of Hormuz, or should be moving out of the Strait of Hormuz. That is roughly 20% of the total capacity. So
yeah.
um, that already is a massive impact. Now, even if you do have a lot of supply on vessels outside, on the water, or strategic reserves, etc., question mark is, if I was the Chinese government, would I be releasing that, at a high speed? Is that really what I should be doing at this stage? Maybe not. Same for the U.S. The situation is quite uncertain, and it's not very clear what is the best strategic direction here in terms of releasing those stocks. But again, there's different ways that the Saudis and the UAE can also reship that crude. You have the East-West pipeline in Saudi Arabia that could
Mm,
move something like 3 to 5 million barrels a day. But again, that's going to take maybe a week,
Time.
yeah, to
Yeah.
make it happen. Then think about the congestion you're going to have in Fujairah. So even if Abu Dhabi then ships most of the crude outside of the strait into Fujairah, but you're going to have a tremendous amount of disruption there. So again, right now, what people are pricing is mostly the logistical disruption
Yes.
rather than the let's say supply disruption. That is what I'm seeing in the market right now, and again, it's
Okay.
the headline price is much higher, but it was lower than what people were expecting.
Absolutely. I mean, if we can just talk about, again, logistics of getting LNG out of the AG. I mean, Qatar being the largest, obviously most significant player in this region, primarily going to Europe. Of course, Europe's also getting US LNG since it has its Russia challenges. But again, 20% of global supply coming out of the Gulf in terms of LNG. I mean, how disruptive do you think that is for Europe and for Asia, if indeed we continue to see logistical challenges?
Yeah, I mean, it's a very similar picture. Ultimately, it's same kind of percentages, roughly 20% of the global supply. You do
Mm,
not have those alternatives that I was mentioning, like the pipeline. So that could be even more impactful. It's interesting you were mentioning Asia versus Europe because we're talking about flat price, but the other measurements of risk management, if you want, is arbitrage, because it's also important where that oil or gas is going to land and at what time, because that is also influencing the price of spreads, cracks, or even geographical spreads. Right
mm.
now, there's going to be a battle for those cargoes between Asia and Europe, for sure. Um, that is also something to be monitoring.
Okay, that's interesting. And I mean, in terms of, if we take, let's go a bit of, I suppose, bigger picture. One thing that obviously does impact the oil price is always demand, and the demand outlook has been a bit, again, there's varying opinions on what that's going to be in 2026. We've had, outfits like the IEA and OPEC adjusting their outlooks in recent months. Not really coming any closer together, perhaps a little bit. But again, global economy outlook, now that we've got a potential, well, we do have a war in the Gulf, and
Yeah.
a lot of people think this will drag on one way or another. That's going to obviously have an impact on the oil price, but also on, GDP
Mm.
forecasts. And would you say that traders in the market will be looking at those already and making those adjustments to US GDP, to European, to Asia, even China GDP, which has been, again, obviously a critical player in the market?
I mean, obviously, the direct impact is on price of energy, natural gas, oil. That's going to affect the market, even if it's just simply the logistical disruptions already are having an impact. Um, Whether it's on crude, but also products, landed prices are going to go up, and that is going to have an impact on the economy for sure. But again, right now, I wouldn't say that is something that traders are top of mind right now. We've, even before this weekend, normally when you look at economic activity, you would be looking at diesel premiums falling because of lack of demand or anything like that.
Mm,
And it's not happening actually. Diesel cracks were already quite healthy. Different story for gasoline, but that's also due to the fact that you always have these winter buildups of gasoline stocks. But we didn't really see any kind of pressure on diesel cracks or diesel spreads. Well, today, obviously, for different reasons, that has spiked tremendously. The diesel crack is something to follow. But I wouldn't say it's top of mind right now. Right now, everyone wants to have a little bit more certainty into, is this going to be lasting for a week, a
yeah.
month, a year? And that is what is going to drive the economic response and also the risk taking from traders.
Absolutely. Well, let's hope it's the former of that time cycle, but I am doubtful of that. I mean, what about the dollar itself? If we just look at the dollar, obviously has been weakening gradually for months now, and of course that always does impact oil demand to an extent, doesn't it? And oil prices. I mean, the correlation between the dollar and oil demand. Do you think we're going to see that shift in any significant way now? As that currency does perhaps become more impacted by the geopolitics, if you like.
Yeah, and I mean, obviously, there's a inverse correlation between dollar strength and oil prices. So the more the dollar weakens, the more, there is a basis for oil to be, the prices to go higher. Um, and it hasn't really happened because of the supply and demand balances that we were talking about before. I wouldn't say that dollar or the FX is having a dramatic impact this year. Um, you would expect higher demand, and we've seen higher demand for gasoline, for products in general. But because of that supply and demand, let's say, glut, we didn't really have a rapid increase in prices. And it's right now not the main driver. It remains geopolitical risks for sure.
And I mean, over the weekend, we had OPEC meeting. They had already scheduled to meet March the 1st. And the expectation for the second quarter was that, they wouldn't change what their current volumes. Now, we did have them pledge to add, another 200,000 barrels a day of oil. Does that make any difference to current market? As you said, logistics is really the key, isn't it? It's not about supply.
The reality is that this volume does very little to soothe the physical market and the Hormuz passage right now.
Mm.
This is not going to be what makes the difference right now. No, absolutely not.
Felipe Schuurman, CEO and co-founder of Sparta Commodities. It's been great to have your perspective on this very important day in oil markets and energy markets. Thanks for coming on.
Thank you very much, Diana. Please, pleasure to be
Great to
here.
have you. Thank you.